Renting isn't the money mistake you think it is. You've probably said it or had it said to you. Renting is throwing money away. It gets repeated at family dinners, in comment sections, by well-meaning coworkers, like it's a law of physics, instead of a guess that almost nobody actually checks. Here's the part that gets left out. In a lot of markets, buying a home is the worst financial decision for years, sometimes for a full decade, and the math says so before your feelings about being a real adult ever get a vote. Owning and renting are not a moral choice between wasting money and building wealth. They're two different financial products, with two different risk profiles, and the one that wins depends on numbers most people never sit down and run. In this episode, you're going to get the actual framework instead of the slogan. The true cost of owning beyond the mortgage payment. The 5% rule as a fast gut check. The opportunity cost of a down payment. The break-even horizon. The price-to-rent ratio for your own market. What each side genuinely buys you. And a short checklist you can run for yourself before you sign anything. No verdict handed to you. Just the math, laid out so you can do it with your own numbers. Let's start with why the slogan survives it all. Renting is throwing money away, works as a line because it has a kernel of truth in it. At the end of a lease, you own nothing. At the end of a mortgage, you own a house. That's a real difference. But it's an incomplete comparison because it only counts what happens at the end, not what happens along the way. And not what else your money could have been doing the entire time. A mortgage payment builds equity, yes, but it also pays interest, taxes, insurance, and repairs, most of which build you nothing. Rent pays for none of that, but it also frees up cash that a homeowner has locked into a down payment, and that cash doesn't have to sit still. Whether renting or buying wins is a question with a locally varying answer, decided by ratios and horizons, not by which option sounds more responsible at a dinner party. So if the slogan is unreliable, what replaces it? That's what the rest of this episode builds, one piece at a time, starting with the number people are almost always underestimating the moment they start comparing a rent check to a mortgage quote. Why the mortgage payment is not the cost of owning. Here's the comparison most people actually run, and it's the wrong one. They pull up a mortgage calculator, type in a home price, get a monthly number, and set it next to their current rent. If the mortgage number looks similar or even a bit higher, buying feels like a wash, maybe even a win, because at least you're building equity. That comparison is broken because the mortgage payment is not the cost of owning a home. It's one line item in a longer list. Property tax runs on top of the mortgage every single year, regardless of whether the home appreciates. Homeowners insurance is mandatory the moment you have a lender involved, and it climbs over time. Maintenance is the one people lowball hardest, and it's commonly modeled at around 1% of the home's value per year, which sounds small until you're looking at a home worth several $100,000 and realize that's thousands of dollars a year. On average, for the roof, the water heater, the furnace, the inevitable repair that shows up the same month as 3 other bills. If it's a condo or a planned community, add HOA fees, which exist specifically to cover the maintenance you didn't budget for. And don't forget closing costs on both ends of the transaction, paid once but real. Put that together, and here's the directional pattern worth remembering. A $2,000 a month mortgage payment routinely hides another $500 to $800 a month in true carrying cost that never shows up on the affordability calculator you used to feel good about the decision. That's not a rounding error. That's the difference between a comparison that actually means something and one that was rigged from the start, not out of malice, just because nobody itemized it. This is the first crack in the slogan. The real cost of owning is bigger than the sticker number every time. Which raises the obvious next question. Is there a fast way to check whether owning even clears the bar without building a spreadsheet from scratch? There is, and it's more useful than most personal finance rules of thumb. The 5% rule as a gut check. Finance educator Ben Felix has popularized a framework worth knowing, sometimes called the unrecoverable cost of homeownership. It's cited widely enough that it's worth understanding the shape of it, even though the exact percentages deserve their own verification, before you'd quote a hard number on air or in a spreadsheet that matters. The rough idea, the annual cost of owning a home. Once you add property tax, maintenance, and the cost of capital tied up in it, lands somewhere around 5% of the home's value per year. Compare that annual figure to what you'd pay in rent for an equivalent property, also on an annual basis. If your annual rent is well under that 5% figure, renting wins the pure math comparison, full stop. If rent is close to or above it, owning starts looking more competitive. This is deliberately a gut check, not a full model. It skips appreciation. It skips tax deductions. It skips the specifics of your mortgage rate. What it's good for is a 5-minute sanity test before you go build the real spreadsheet, the kind of test that tells you whether it's even worth spending a weekend on a deeper analysis. Try it with round numbers. A $400,000 home at 5% is $20,000 a year in true unrecoverable cost, before a dollar of equity even enters the picture, which is a little under $1,700 a month. If a comparable rental in the same neighborhood goes for $1,500 a month, renting is ahead before you've done anything sophisticated. If that same rental goes for $2,800 a month, the math starts tilting the other way. The 5% rule is fast, it's rough, and it's exactly the kind of number the slogan crowd never runs. But it still leaves out one of the biggest line items of all, the one that lives in a place most people never think to look. What the down payment itself is quietly costing you by sitting where it sits. The opportunity cost nobody puts in the spreadsheet. Here's a sentence worth sitting with. A down payment isn't saved. It's deployed. The moment it leaves your account and goes toward a house, it stops being available to do anything else. And that anything else is not nothing. It's the missing half of every honest rent versus buy comparison. Take a 20% down payment on a $400,000 home. That's $80,000. Renters comparing themselves to buyers usually picture that $80,000 as money the buyer has, and they don't. But that $80,000 could instead sit in a diversified index fund, growing at a market rate of return, completely independent of what happens to that one specific house. Over long stretches, broad equity markets have historically outpaced housing appreciation by a meaningful margin. Robert Shiller's long-run research on U.S. housing prices, laid out in Irrational Exuberance, found that real home prices stayed roughly flat for most of the 20th century, only breaking into a sustained run-up in the years leading into the 2000s. A house is shelter first. Historically, it has not reliably been a growth asset the way a diversified portfolio has been. That gap between what the down payment could have earned invested and what it earns as home equity is the real hidden line item, the one that never makes it into an affordability calculator, because a mortgage calculator has no field for what if you didn't. A renter who takes the difference between their rent and what a mortgage payment would have cost and actually invests it instead of spending it is running the other side of this comparison in real time, whether they realize it or not. This is also the point where the comparison stops being abstract and starts being personal, because it depends entirely on what you'd have actually done with that money. If the alternative to a down payment is a diversified fund left alone for a decade, the opportunity cost is real and often large. If the honest alternative is spending it, the opportunity cost mostly disappears, and owning looks better by comparison, which is exactly why the next number matters just as much as this one. How long you'd need to stay in the house for any of this to pay off at all. The break-even horizon that actually decides it. Buying and selling a home both cost money, on top of the price of the home itself, and this is where a lot of otherwise reasonable buyers get caught off guard. Closing costs on the purchase side typically run somewhere around 2 to 5% of the price. Selling costs, mostly realtor commissions and related fees, typically run higher, somewhere around 6 to 10% combined. Stack those two together, and you're often looking at 8 to 15% of the home's value just to get in and back out. That means buying a home is not a bet that owning beats renting in general. It's a bet that you'll stay long enough to amortize those transaction costs across enough years that they stop mattering. Sell too soon, and those costs alone can wipe out any equity gain you built, sometimes more. Here's the directional pattern to actually remember. A household that moves every 3 to 4 years for work, for relationships, for whatever reason, is structurally a renter, no matter how attractive the monthly payment comparison looks on paper. It doesn't matter if the numbers favor buying at year 7, if you're gone by year 3. The break-even horizon isn't a detail. For a lot of people, it's the single number that decides the entire question, more than the interest rate, more than the down payment size, more than any slogan about equity. So the real question isn't just, does buying beat renting? It's, does buying beat renting, given how long I'm actually going to stay? And that answer changes depending on where you live, because the break-even math looks completely different depending on the ratio between home prices and rent in your specific city, which is the next piece of the puzzle. Reading your specific market. Every number so far has been generic on purpose, because the actual answer to rent versus buy is not generic at all. It's local, sometimes down to the specific neighborhood. The tool that captures this best is the price-to-rent ratio. Take the price of a home, divide it by the annual rent of a comparable unit, and you get a number that swings wildly depending on where you're standing. Outlets like the New York Times, in their well-known rent versus buy calculator, lean on this same underlying concept, and the pattern holds up everywhere it's been studied. A market with a price-to-rent ratio near 15 tends to favor buying, because home prices are low relative to what landlords can charge for the same space. A market with a ratio near 30 or higher tends to favor renting hard, because home prices have run so far ahead of rents that owning stops making mathematical sense for most people, even with a long time horizon. Same country, opposite answer, depending on the zip code. A mid-sized metro with reasonable home prices and strong rental demand might sit at a price-to-rent ratio of 12, which is a green light to buy if the rest of your numbers line up. A dense coastal city with home prices inflated by scarcity and demand might sit north of 30, where buying is close to indefensible on pure financial terms, no matter how good your job or how stable your 5-year plan feels. This is the number that makes rent versus buy a genuinely bad question to ask in general terms. The real question is, rent versus buy in this specific market, at this specific ratio. And until you look that number up for where you actually live, every other calculation in this episode is still floating in theory. Once you've got the cold financial read on your market, it's worth pausing on something the spreadsheet can't measure at all, because owning does buy you real things that never show up in a price-to-rent ratio. What ownership actually buys you. None of this is an argument that owning is irrational. It's an argument that the wealth-building framing is usually the wrong justification for it. What owning actually buys you is a different list, and it's worth taking seriously on its own terms instead of dressing it up as a financial slam dunk. Ownership forces a kind of savings discipline that a lot of people genuinely need. A mortgage payment is non-negotiable, month after month, and the equity that builds behind it is savings you can't easily skip the way you might skip a transfer into an investment account. It's also a hedge against your specific local rent rising unpredictably, because once a fixed-rate mortgage is locked, your core housing cost is locked with it, while a landlord's renewal notice is under no such obligation. And there's the control factor. Renovate the kitchen, Paint the walls, whatever color you want. Get the dog the lease would have blocked. Make structural decisions about the space you live in without asking anyone's permission. These are real benefits. They're just not, on their own, the wealth-building argument people reach for. A forced savings mechanism is genuinely useful for someone who knows they won't otherwise save consistently, and that's a legitimate, blunt, practical reason to buy. Even if the pure math tilts slightly toward renting in their market, a fixed housing cost is genuinely valuable to someone who wants predictability over the next 20 years, even if it costs them some flexibility today. None of that requires pretending a house outperforms a diversified portfolio, because for most of history, it hasn't had to. So owning has a real column of benefits, non-financial and financial both, and they matter. But renting has its own column, and it's usually undersold just as badly in the opposite direction by people who've already decided owning is the mature choice before running a single number. What renting actually buys you. Flip the comparison and look at what renting actually delivers, because the throwing money away framing buries almost all of it. Renting buys mobility. If a better job shows up 2 states away, or a relationship changes your plans, or your industry has a bad year and you need to relocate for work, a renter can leave at the end of a lease. A homeowner has to sell first, in a market and timeline they don't control, eating those closing and selling costs from earlier in this episode along the way. Renting also buys zero exposure to the physical risk of the building itself. A leaking roof, a dying furnace, a foundation issue. These are the landlord's financial problem, not yours. That's not a small thing. Those are exactly the costs the 5% rule and the 1% of home value per year maintenance estimate are trying to capture. And a renter simply doesn't carry that risk at all. And then there's the piece that gets undersold hardest of all: liquidity. The difference between rent and what a mortgage would have cost when actually invested instead of spent stays flexible. It can be redirected, rebalanced, pulled from in an emergency, diversified across an entire market instead of concentrated into one specific structure on one specific street. A single house is about as concentrated a bet as an investment portfolio gets, tied to one local economy, one local job market, one set of local risks. Renting and investing the difference keeps your money spread out and liquid, which matters enormously if life doesn't go according to plan, and life rarely goes exactly according to plan. None of this makes renting automatically the smarter choice either. It makes it a real financial position with real advantages, not a consolation prize for people who couldn't quite manage to buy. Which brings up the one risk baked into homeownership that doesn't get nearly enough airtime, because it's the mechanism that turns an ordinary market dip into a genuine financial crisis for the wrong buyer. The leverage trap. A mortgage is leverage, and leverage is a double-edged tool that magnifies whatever happens next in either direction. Put 20% down on a home, and you're controlling an asset with roughly 5 times leverage. Put 5% down, which some loan programs allow, and you're at roughly 20 times leverage. That's the mechanism that makes homeownership feel like a wealth-building machine when prices rise. And it's the exact same mechanism that turns a modest downturn into a financial gut punch when they don't. Here's the blunt version of the math. A 20% down buyer who sees the home's value drop by 10% hasn't lost 10% of their money. They've lost 50% or more of their actual equity, because that 10% drop is measured against the full price of the home, not against the 20% they actually put in. A 5% down buyer facing that same 10% drop is underwater entirely, owing more than the home is worth. 2008 is the case study everyone reaches for, and it deserves the reputation, but it's worth being precise about why. It wasn't just that home prices fell. It's that a huge number of buyers were leveraged so heavily, often with minimal or no down payment, that even a moderate price correction wiped out their equity completely and left many owing more than their homes were worth. The mechanism didn't require a historic crash to hurt people. It requires an ordinary downturn and a highly leveraged buyer. And that combination has shown up in smaller, quieter versions plenty of times since, in specific cities and specific years that never made the history books the way 2008 did. This doesn't mean leverage is bad. Leverage is exactly why homeownership can build wealth faster than renting and investing when prices rise, because the gains are also magnified. It means leverage is a risk that has to be priced in honestly, not waved away with real estate always goes up, because it demonstrably doesn't always go up. And when it doesn't, the buyer holding the most leverage takes the biggest hit. With all these pieces on the table now, it's worth seeing how differently they add up depending on where you actually are, which is exactly what two real directional case studies make obvious. Two cities, two different answers. Put the whole framework to work on two different markets side by side, because this is where rent versus buy stops being an abstract debate and starts looking like an actual decision. Take a high-cost coastal city where the price-to-rent ratio sits near 30. Home prices there have run far ahead of what rent actually costs for a comparable unit. Run the 5% rule, and renting comes out ahead by a wide margin. Run the opportunity cost of the down payment. And in a market like that, the down payment required is often large enough that the invested alternative compounds into a genuinely significant sum over a decade. In this kind of market, renting and investing the difference tends to win on the numbers. Not by a little, but clearly, and it takes a long stay and a strong non-financial reason to make buying the better call there. Now take a lower-cost metro, where the price-to-rent ratio sits closer to 12 to 15. Home prices there are much more in line with what rent would cost for the same space. Run the 5% rule, and the gap between renting and owning narrows sharply, sometimes flipping in favor of buying outright. The down payment required is smaller in absolute terms, which shrinks the opportunity cost sitting on the other side of the ledger. In a market like that, buying tends to win on the numbers, especially for someone planning to stay past the break-even horizon. Same framework, same 5 factors, two opposite conclusions, because the inputs are genuinely different, not because one city's residents are smarter or more financially responsible than the others. This is the entire point buried underneath the slogan. Rent versus buy has no single universal answer. It only ever has a local one, built from your specific price-to-rent ratio, your specific time horizon, and your specific alternative use for the money, which means the only useful next step is turning all of this into a short list of questions you can actually run for yourself. The questions to actually run before deciding. Here's the checklist, stripped down to what actually moves the answer. Not a verdict handed to you, just the inputs worth gathering before you sign anything. How long do you realistically expect to stay in this home? Not the plan you'd tell a loan officer, the honest guess based on your career trajectory, your relationships, and your track record of staying put or not. This single number decides whether the break-even horizon even works in your favor. What's the price-to-rent ratio in your specific market for a comparable property, not a citywide average pulled from a headline? A ratio near 15 or below leans toward buying. A ratio near 30 or above leans hard toward renting. Look it up for your actual neighborhood before you trust either instinct. What would the down payment realistically earn if invested instead, given what you'd actually do with that money if you didn't spend it on a house? Be honest here. The opportunity cost only counts if the alternative was genuinely going to happen. What's your tolerance for holding one illiquid, undiversified asset tied to one local economy versus keeping that same money spread across a diversified, liquid portfolio you could access if life changed direction on short notice? Run those 4 questions with your own numbers, and you'll have something the slogan never gave you. An actual answer built for your situation instead of borrowed from someone else's dinner table opinion. That answer might land on buy. It might land on rent and invest. Either way, it'll be yours, and it'll be correct for the market and the life you're actually in. It's a spreadsheet decision, wearing an identity costume. Here's the recap, chapter by chapter, because it's worth holding the whole shape of this in your head at once. The slogan that renting is throwing money away survives because it's half true and treated as whole. The mortgage payment isn't the true cost of owning once tax, insurance, maintenance, and fees get added in. The 5% rule gives a fast gut check against your local rent. The down payment isn't saved, it's deployed, and whatever it could have earned elsewhere is the hidden line item most people never write down. Closing and selling costs mean buying only wins if you stay long enough to amortize them. The price-to-rent ratio swings the entire answer by city, sometimes by neighborhood. Owning buys forced discipline, a rate hedge, and control, real benefits that aren't the same as outperforming the market. Renting buys mobility, zero maintenance risk, and liquidity, undersold just as badly in the other direction. Leverage is the mechanism that makes owning either build wealth fast or lose it fast, depending on which way the market moves while you're holding it. Two different cities can run the exact same framework and land on opposite, equally correct answers. And the checklist at the end of all of it turns the whole debate into 4 honest questions instead of one repeated slogan. Renting versus buying gets treated like a referendum on whether you've got your life together, when it was never that kind of question at all. It's a spreadsheet decision wearing an identity costume, dressed up as a statement about who you are instead of what the numbers in your specific market actually say. Run the real math for your real city, your real timeline, and your real alternative use for that money. And you'll land on the answer that's actually right for you, not the one that sounds best at a party. If this kind of straight numbers breakdown is useful to you, stick around. There's a lot more of it coming.